Mark Zuckerberg and Jeff Bezos are just two of the high-profile insiders who have recently been aggressively selling shares in their respective companies, Meta and Amazon. But now we are starting to see the volume of insider sales, especially in the tech sector, ramp up as high-profile executives are increasingly dumping their stock, seemingly looking for the exit from the stock market right around the same time that many stocks are reaching all-time highs. So Mark Zuckerberg has now sold over $2 billion worth of his Meta shares over the last 6 months or so, making this the first selling spree that he has been on since the end of 2021. Now, Jeff Bezos has also sold over $8 billion worth of Amazon shares early this year, the first sale that he has made since 2021 as well. It would appear that insiders have a great ability to time the market, as these 2021 sales from both Zuckerberg and Bezos came when Meta and Amazon stock were at all-time highs at the time, shortly before both stocks suffered massive corrections in 2022, with Meta falling over 60% and Amazon falling by over 50%. Now, even more insiders from the Magnificent Seven tech companies are cashing out their shares, with almost a dozen executives and directors selling over $160 million worth in shares since late 2023, after not cutting their stakes in as long as 9 years in some cases, according to Bloomberg. Alphabet CEO Sundar Pichai has now sold more Google shares in 2024 than he did for the whole of 2023, cashing in $30 million. Other senior members of Alphabet, Amazon, Apple, Microsoft, Nvidia, and Tesla have all begun to start making stock sales as well, many of which for the first time in a number of years, and some of these are not according to a trading plan. These 7 tech companies as a collective have risen by 150% since the start of last year, so these recent stock sales from high-profile insiders is certainly a warning sign on where they believe valuations are right now and where the stock prices could be heading in the near future. This is especially the case when you consider how accurate these insiders seem to be with timing their stock sales, with many of them making significant sales in 2021 when the market last topped for these tech stocks. Put all of the insider transactions together, and you feel they are calling a bit of the top of the market, said Claire Madden, managing partner of private equity firm Connection Capital. Lloyd Grief, founder of investment bank Grief & Co., also said, "They all understand that pigs get fat and hogs get slaughtered. No one can time the top of the stock market perfectly, and it certainly looks pretty frothy right now." He added that he wasn't surprised that many insiders are cashing in on the recent rally, and that no one wants to get caught standing in a game of musical chairs when the music stops. And we certainly don't just need trading activity from insiders to tell us that the market is looking expensive right now, as there are a number of key indicators that are screaming that a stock market correction is due and that things are pretty overvalued right now. First of all, just simply looking at a simple metric like the forward PE ratio of the market will tell us that valuations are high at the moment. The current forward PE ratio of the S&P 500 is 20.3, and there have only ever been 2 periods in history where this metric was this high. One of these times was in 2021, which, as we mentioned earlier, proved to be a market top before a significant correction took place. And the other time was during the dot-com bubble era, and we all know what happened to the market shortly after this period of time. The Wilshire 5000 to GDP ratio, which has been dubbed the Buffett indicator, is another very well-respected indicator to judge how overvalued or undervalued the stock market is. Buffett himself referred to it as probably the best single measure of where valuations stand at any given moment, and the metric is calculated by dividing the total market value of all publicly traded stocks in the US by the GDP of the US. Right now, the Buffett indicator is sitting at 183%, which is just below the peak that we saw in 2021, but higher than every other point in history, including the peak of previous market crashes like in 2007 and also the dot-com bubble. It's also more than double the 90% that is the historic mean of this ratio since 1970. Therefore, this Buffett indicator is showing that, with the exception of the 2021 time period that proved to be a bubble, at this current moment in time, the valuation of the US stock market has never been higher in relation to its economic output and performance. Warren Buffett himself may well be using this indicator to assess how much value there is in the market right now, as we have recently seen him sell stocks at his company Berkshire Hathaway, cutting their stake in Apple, which does remain their largest holding, by 13% in Q1 of 2024. And Buffett is not redeploying this cash elsewhere in the market at the moment, as Berkshire's cash pile has risen to $189 billion, a sharp increase from the previous quarter, and is now the highest it has ever been. The fact that Buffett is continuing to stockpile more and more cash, now accounting for 35% of the Berkshire investment portfolio, and is even selling out of his highest conviction stocks like Apple to do so, really is very telling of his current view of the economic landscape and stock valuations. Buffett is undoubtedly bearish on stocks right now and must believe that a correction is coming where he will be able to take advantage of this large cash pile by deploying it into stocks. Now, aside from lofty valuations, another big thing that the stock market has going against it at the moment is an economy that is deteriorating, with consumers becoming weaker and weaker and an impending recession looking inevitable. The yield curve in treasuries has been inverted for close to 2 years now, and an inverted yield curve has historically been a very accurate signal for an upcoming recession. Just looking at this chart showing the historic yield curve between 10-year and 2-year treasuries, we can see that a yield curve inversion happened before all historic recessionary periods. This includes recessions in the 1980s and 1990s, as well as the early 2000s dot-com bubble recession and the global financial crisis in 2008. And as you can see by this comparison between the yield curve and the Wilshire 5000 total stock market index on an annual percentage change basis, we can see that during these recessionary periods, all of which have been forecasted by a yield curve inversion, the stock market has suffered significant losses. This includes annual falls as steep as 43% in 2009, with the declines lasting a number of consecutive years in most cases once a recession does hit. The fact that in this moment in time we've not only just seen the yield curve invert, but invert deeper and for a longer period of time than recent historical recessions, it is a big warning sign of what could be about to hit this economy in the future. And we've already seen concerning signs of deteriorating economic conditions coming from a number of big consumer discretionary companies like Starbucks, McDonald's, and also Tyson Foods, who all reported disappointing earnings recently. And executives and senior management from all of these companies did issue warnings about weakening consumer spending power on their earnings calls as well, saying that consumers have less money and many of which are really struggling financially. The data backs this up, showing that consumers are saving just 3.2% of their income on average, which is less than most points in history, and about half what they were saving pre-pandemic. And many consumers are being squeezed to the absolute limit by this cost of living crisis, and many are turning to credit cards to keep food on the table, as we can see by the recent surge in credit card debt. A lot of this consumer weakness has been driven by out of control inflation over the last year or so, and the inflation problem is certainly not over and has started to tick upwards again. It goes without saying that as consumer spending power does get weaker, many stocks are going to see weaker earnings and less profit, which is in a rational market going to have a hit on their stock prices. Earnings getting weaker in the future could have a detrimental effect on a stock market that is already looking overvalued by many indicators and metrics. Low savings and high credit card debt is just the tip of the iceberg for consumer woes, and there is a whole load more evidence to suggest consumer spending power is about to get decimated, including a rapidly worsening job market. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, please leave a like and subscribe if you enjoyed the video. That does help out the channel a lot, and thanks a lot for watching.